was really to see whether it's possible to update the Unbreakable model work that Stefan and Branka and others worked on a number of years ago. And this work really takes a sort of one approach at trying to come up with what the costs of disasters are for households. And it starts with using a physical model of a physical risk model, but adding in country and household level socioeconomic data to try and come up with the economic costs. I think that we've been doing this work alongside a very different approach to try and come up with costs and identify who's vulnerable, which is sort of a more proxy approach around counting the number of people that are at risk. And I think it's really useful to have these multiple approaches being done alongside each other because no one approach is perfect. And I think we're learning different things from each process. And I think it will be really nice to line these things up as well and see, what do we learn about what gets picked up in different models. But for now, I'd like to hand over to Robin, who's really been spearheading this update over the last few months to present where we've got to. We're going to have like a 20-minute presentation from Robin. And then we've got an amazing set of discussants. So we have Jim, actually all online, I think. No, you're here. Sorry, I'm like staring at you. So we have Jameli online, Julie here, and Javier, I hope, is online as well. Yes, he is. I see him. I can see her. Great. And yeah, so we'll actually probably have about 20 minutes of discussive comments as well between the three of you, and then great to get questions from in the physical and virtual room, and have a bit of time for Q&A. But and I think, the goal is really to think about, how this work gets updated. So I think comments at this moment are really fantastic because this is sort of the moment at which we can, I think Robin's done all the hard work in updating the data and bringing the data together, but sort of any sort of ways that we can push the method forward, it would be great to hear your comments on that. So over to you, Robin.
Cool. Thanks a lot, Ruth, for the kind introduction. And also, hi, everybody. Very nice to be here today to present the update that we did to the global Unbreakable model throughout roughly the last half years. This is work that I've been doing together with Branka, with Ruth, and with Stefan. And I'll be giving a global perspective on socioeconomic resilience to natural disasters globally. And Ruth already touched a little bit upon what is meant by socioeconomic resilience. So the goal of the Unbreakable model really is to look into well-being impacts or welfare impacts from the assets that we or countries suffer from natural disasters. And I'll be starting with the motivation for the model itself and the analyses, and walk you through the methods, specifically the model and the model update, but also the data that we've been using, and then present some results, both with regards to the drivers of socioeconomic resilience, but also we've looked into ways of how we might increase socioeconomic resilience and reduce well-being impacts before finally I'll conclude. And the starting point for the Unbreakable model itself is that in many risk assessments, we try to get estimates of asset losses from a hazard given exposure and vulnerability, but such risk analyses that focus on asset losses often miss certain dimensions that are important for the impact on well-being of people. For example, they do not take into account on who specifically is affected. So that is one dimension that we want to account for. And I guess it's quite obvious that, for example, if we have $1,000 of asset losses that a poor person has, this will mean something very different for a poor person than for a comparatively rich person. So this is something that we account for, distributional effects. And another aspect that is often not being accounted for is the temporal dimension of how asset losses are being rebuilt over time, because also this has an impact on the well-being of people. And consider, for example, a fast versus a slow recovery. We generally assume, or generally assets have productivity. So when capital gets destroyed, then income is lost. And if we consider a fast recovery, as shown here, exemplary on the left, then of course the income losses also decay more quickly, but it does come at a cost of a higher reconstruction burden. So people will have to reduce their consumption further to quickly recover from the asset losses, as opposed to a slow recovery where the recovery cost is spread over a longer period of time. But this comes at the expense of the income losses being also dragged on over time, basically. And these are the two aspects that we account for in the Unbreakable model. The framework basically looks as follows: that we start with asset losses at the country level, so aggregated numbers for tropical cyclones, tsunamis, floods, and earthquakes. And then we start by disaggregating these asset losses to the household level. We account for 5 income quintiles per country. And then we derive consumption losses using productivity of capital from these asset losses. And as I've already indicated, these consumption losses consist of income losses on the one hand, but also reconstruction costs on the other hand. And then these consumption losses are transferred into well-being or welfare losses using a welfare function. So this way we can estimate the well-being impact for individual income quintiles and account for who specifically is being affected by the disaster. And then the third element of the model that we've been working on is welfare or well-being loss minimization to find the optimal recovery trajectory. As I've already said before, households can decide whether or not they want to decide fast or relatively slow, and there will be some welfare optimal recovery trajectory that we find by minimizing the well-being losses with regards to the recovery speed. We use different data sets that can be broadly classified into hazard-related data, macroeconomic, but also household-level data. And with regards to the hazards, we use loss projections from the CDRI, so asset losses at the country level. We account for hazard protection, but also for exposure biases by income quintiles. So different income quintiles may be exposed more than other income quintiles. And we also take into account disaster preparedness and early warning systems if they're available, because we assume that this can reduce vulnerability. At the macro level, we use GDP and population, so macroeconomic indicators, but as well capital data from the Penrose table, which we use to derive productivity of capital. We use capital data from the IMF to estimate shares of income that are privately owned by households, because this is what they have to repair at their own expense. We use credit ratings to estimate the ability of countries to finance post-disaster support and compute or calculate country-level asset vulnerability from the global exposure model, which is basically a global inventory of buildings. And finally, when we come to the household level, we obtain income per quintile for all countries from the World Bank Poverty and Inequality Platform. We estimate household level asset vulnerability, which will be used to distribute the asset losses between income quintiles from the global monitoring database. And we get the volumes of remittances, transfers, and social protection for each income quintile from the most recent Aspire data set, which we use to estimate the share of diversified income, because diversified income is susceptible to asset losses at the national level, whereas labor income is susceptible to asset losses from disasters at the local scale. And finally, we use data on financial inclusion and liquid savings, or also the ability to borrow money per household from the most recent Findex data set. And these, or basically liquid savings, and if people can borrow money, this can accelerate the reconstruction of assets. But I'll talk about that in a little more detail later on in the talk. So as I've said, the central figure of merit, or the central characteristic of countries that we compute using the Unbreakable model, is the socioeconomic resilience. And it is defined as the ratio of asset losses to the resulting well-being losses that people experience. And the rationale behind this is that this gives us a metric to know how capable a country is to minimize the well-being impact that results from asset losses. And consider, for example, the imaginary case of $1 of asset losses, but 0 well-being losses. Well, then this means that socioeconomic resilience will be infinite. So basically, there is no well-being impact, even though assets are lost. Or conversely, if we have, for example, a socioeconomic resilience of 0.5 or 50%, well, then this means that each $1 in asset losses translates into $2 of well-being losses. And we ran or computed socioeconomic resilience for a total of 127 countries globally. We see here on the left in green the asset losses as per the CDRI data set that we're using, and then the resulting well-being losses, both in percent of GDP in the bottom from the Unbreakable simulations, and then on the right we see the socioeconomic resilience. And something that kind of jumps the eye is that there is quite some regional heterogeneity between countries. So the global south tends to have lower socioeconomic resilience than countries in the northern hemisphere. And we'll be talking a bit or looking a bit more into the reasons and drivers for socioeconomic resilience in the following. Here again, I first want to show you the asset losses and resulting well-being losses as simulated by the model over GDP per capita. What we see is that both asset and well-being losses decrease strongly with GDP or the economic strength of a country. And what we also see is that those countries that experience the highest asset losses also show the highest losses in terms of well-being, which is not surprising. But when we look at countries individually, we do see some differences in how well they cope. For example, consider the countries of Tajikistan and Haiti. Both have the highest asset losses, also both have the highest well-being losses. But while asset losses are somewhat similar, 2.5% in terms of GDP, the well-being losses are very different. Haiti has somewhat more than 5%, whereas this number ranges below 3% for Tajikistan. And this is exactly what is measured then by the socioeconomic resilience. So obviously, Tajikistan copes better with the asset losses that it experiences. And as I said, this is what is measured by resilience. Then in turn, here we see socioeconomic resilience over GDP per capita. Note that, for example, Tajikistan, I don't know if you can see the cursor, yeah, I think you do, up here has a resilience of close to 90%, whereas this value ranges about 45% for Haiti. What we also see, though, is that there is quite a strong dependency between the resilience of a country and its GDP or the economic strength. Indeed, when we look into or group this by income group, then we see that the higher income countries tend to have a higher resilience score. But at the same time, again, considering, for example, Tajikistan and Haiti, but also the entire lower middle income group, we see that also the spread can still be quite big. So obviously, while GDP is a good indicator or a strong driver, it is not the only influence or the only thing that influences resilience of a country. There are indeed multiple numbers of drivers, for example, safety net systems, the availability or the amounts of savings and household liquidity, early warning systems, and disaster preparedness, but also inequality, as well as asset vulnerability, income diversification, and the share of self-employment within the country. I won't be talking about all of these, but I'd like to touch upon some of them and now start with the role of within country income inequality for socioeconomic resilience. Here we see the socioeconomic resilience plotted over the Gini index for all of 127 countries that we simulated. Yeah, and I mean, a Gini index of 100% basically means all is earned by a single person, right? Whereas the Gini index of 0 would indicate perfect equality with regards to income. And we do see that inequality basically decrease or correlates with low resilience scores. And indeed, when we look into the shares of income quintiles across all countries in their respective asset and well-being losses, then we see, considering, for example, the bottom income quintile, that even though at the median, the bottom income quintile or 10% of asset losses accrue to the bottom income quintile, they are responsible or experience about 30% of the resulting well-being losses. And this is quite the inverse for the top income quintile. So we really see that inequality does play a central role. So given this, one might want to think about how can we then specifically maybe target the poor. And therefore, in one simulation, we looked into what happens if we could decrease the exposure of the poor such that the country exposure overall decreases by 5%. And we see here the results, both in absolute terms and relative terms, the avoided well-being and asset losses for the top ranging countries in both terms. Globally, this measure would reduce asset losses by about $6.7 billion, which is equivalent to a decrease in 2.6%, or translates into $14 billion in avoided well-being losses. So we see that there is a ratio of about each $1 in asset losses decreasing, or avoided asset losses decreasing, the well-being impact by somewhat more than $2. Now, when we just, as a comparison, also ran this analysis, if we do not target the non-poor, but specifically all income quintiles, but the poor, well, then we do see some interesting things that I'd like to point out. First of all, it's not the case that all countries necessarily show bigger welfare decreases. For example, consider China, there the welfare decrease is actually much bigger, but this is simply due to the fact that more or richer people basically also have more assets that they could lose, right? And this is also for other countries, this is different. For example, I believe India is a country where the welfare decrease is actually bigger when we target specifically the poor. And another thing to note is also that while previously targeting the poor specifically, welfare losses could be decreased in relative terms by up to 7%. This is now at most around 6%. Okay, so now we've looked into the role of exposure, what would happen if we could reduce exposure. Another thing that one might want to try is reduce vulnerability of the countries. And here, or generally in the model based on case studies, we say that vulnerability can be reduced by up to 20% due to early warning systems. So if early warning were perfect, and we scaled here back the availability of early warning system back to 1987 using forecast accuracy of weather predictions, basically considering all else equal. And this we estimate this way that up to $500 billion in asset losses could be avoided or have been avoided throughout these roughly 40 years, which translates into up to $825 billion in well-being losses. Now, if we consider what would happen if early warning were perfect, so we see there's still a gap. Early warning is not perfect as of today, but if it were, then we could decrease asset losses by another roughly $7 billion per year, and that would be equal to about $12 billion in welfare losses being avoided each year, and that would then amount to a total avoided well-being losses of $43 billion each year. Okay, so after exposure, vulnerability, these two things, I'd like to now come to a more household-specific measure that one might consider the role of financial inclusion to household welfare, and also later on come to the role of post-disaster support in that regard. Here we see the recovery dynamics of a Colombian household in the bottom income quintile, which is hit by a 5,000-year return period earthquake. And on the left, we see the consumption over time and capital loss over time if this household does not have any liquid savings or ability to borrow money. And on the right-hand side, we see this household, the recovery trajectory, if it has those abilities. And what we can see right away is that the ability to borrow money, to have liquid savings, that it increases the recovery duration. If we consider, for example, the consumption loss trajectory on the right-hand side, the hatched area is basically what the household can offset using savings. And we see that this trajectory would simply not be possible if it were without savings, because it would actually require negative consumption, which, well, obviously is not possible. When we take the global perspective again, then we see that socioeconomic resilience increases for all simulated countries when households have savings and the ability to borrowing, and this translates then in generally decreased recovery time to recover assets, here shown for all households. And the recovery time decrease can be quite substantial, of several years for some households. In turn, this also then decreases the well-being losses that households experience from natural disasters, and low-income countries at the median, or well-being losses of low-income countries decreased by about 22%, while this figure ranges around 7% for high-income countries. But one thing to note here is also that high-income countries already generally have higher socioeconomic resilience. So there is also, in that sense, less to gain for high-income countries, as a tendency at least. And finally, I want to talk about the impact of post-disaster support, which is structurally similar to what we've seen before. So post-disaster support in the model is a one-time payment that is paid to all affected households, and this one-time payment is equal to 80% of the asset losses as experienced by the poorest income quintile. So it basically tops up the liquid savings that households have. And we see in the left figure again that socioeconomic resilience is increased for all countries if countries issue this post-disaster support, and equivalently the recovery duration will decrease. Okay, and with that last point, I'd like to conclude and draw your attention to some of the central points that you might want to take home. So first of all, we started by the argument that asset losses as a risk metric miss certain aspects, for example, distributional effects, but also the implications for welfare from the recovery trajectory over time. So we used the socioeconomic resilience. I guess now it's working. Thank you. So the socioeconomic resilience, we use that metric, which is defined as the ratio of asset to welfare losses. And we've seen that overall economic strength, but also the within-country inequality are central drivers for socioeconomic resilience. And then looking into how one might increase resilience or reduce welfare losses, we saw that reducing the exposure of the poor may decrease global asset losses by around 2.6%, but welfare losses by up to 4%. We looked into the role of vulnerability, for example, through the role of early warning, and saw that a functioning early warning system could decrease or could lead to well-being losses avoided of up to $43 billion per year. And finally, we looked into the role of savings and post-disaster support, and post-disaster support can decrease well-being losses by around 5% for high-income countries and up to 18% for low-income countries. And as a last kind of outlook, I just want to highlight that there is also a country-level application of the Unbreakable model. So while we here ran a global analysis, there is this country-specific application where we use full household surveys rather than the aggregated ones as we used here in the global application. And we can represent spatially disaggregated hazard footprints. And this then allows for more fine-grained hazard well-being analyses, but also with regards to the policy implications that this has. And with that, I'd like to thank you for your attention, and we'll be very much looking forward to the discussion. Thanks.
And maybe if I can just make one point on your last point on the country model. I think one of the things that Robin did, I should say, is to bring some of the innovation that were made at the country level, and Brian was leading the work in the Philippines, in Sri Lanka, and so on. And so we had the country models diverge from the global one, and now I think we're just reconciling by bringing a lot of those things into the global model, so we have more of a hierarchical thing that we can have the global model giving you a first number to start with, and when you build to the country level, it's not completely different, which was a bit of a challenge in the Philippines, especially. We had very different results, and it's difficult to explain. So now, hopefully, we're a little bit more consistent on that.
Great. So, Julie, do you want to?
Yeah, sure. Thank you. Well, I'm quite familiar with the model because I've worked with Brian in many countries, actually, with the country version of the model, a bit less with the global version, but it's nice to see that it's being revived and updated and that some of these features are taken into account. I guess I have one main question was, what's the best use that we can do with the global model? And it might be a question for you and not necessarily for Robin, but Robin, you're welcome to answer. Because I can see very well the use of the country model. The global model, my understanding at the beginning was kind of, the idea was to replace some of those very aggregated indices that would bring a lot of indicators together and say this country is more vulnerable than another, but we don't really understand why. So that might be one way. And if that's the case, I think it would be great to do a bit more sensitivity analysis to try to understand, why socioeconomic resilience is so different from one country to the next. What's the driver of high versus low? I mean, you've shown the difference between Haiti and Tajikistan. What's behind it? Is it only inequality? Is it something else? I don't know if you can do clusters of countries, for example, like really use the fact that you have a global version of the model to draw some like interesting conclusions from there. Also, maybe whether there are police interventions that work better in some countries than others. I was recently in a review meeting, a decision meeting for a paper on disaster risk financing in Turkey, and the country director said, yeah, that's great, but I need you to rewrite the whole paper because I want you to show me that disaster risk financing is a better use of government money than reducing exposure. That clearly this kind of model is the tool that you could use to look at that. I actually looked, after he asked that question, I went back to the first version of the global model and DRF, because there was something like that in the first version. DRF had like very small efficiency and exposure had a huge one, that I didn't want to point out. I don't know if that's something that, that could be used in general. I had never heard that question before, but apparently it's a question that some country directors have. And then the last one, the last set of comments is more on the concept of well-being. I remember that when we used to work with the model and try to explain well-being losses to non-economists, they always struggle. But we jumped from asset losses to well-being losses, but I think there's a lot of very interesting steps in between that can also be explained, because in what I've seen at the bank, we often stop at asset losses, maybe income losses. At least in what I've seen done in CCDRs, because that's all I do with my time these days. But in the model, you have these consumption losses, these recovery dynamics, the early warning systems that I've never seen in any poverty analysis that I think is worth breaking down and maybe providing a menu of things that can be modeled instead of jumping directly to well-being. Because I find it easier to explain, and then you can have a set of metrics to communicate on. The recovery dynamic is very important because at least in some risk assessments that I've done, it's always the driver of total costs, how long you take to recover, and the fact that you also translate that into consumption and potentially distributional impacts, I think is very important and innovative. So yeah, in general, if we could do more on the consumption impacts of disasters, I think that could be very helpful. Also climate impacts, because so far in what I've done in my CCDRs, we focused on modeling climate shocks on income, while I'm sure that through prices and consumption, there's a lot more happening. And that's a discussion that we just had with Tom about Moldova, right? So I'll stop here. Thanks.
Great, thank you very much, Julie. So, Jamali, do you want to go next? And then here.
Yes, thank you. First, let me tell you, this is great, and I'm going to tell you later why this is great, because I really believe this is great. But let me go first to the nerdy comments. I don't know well the Unbreakable model, but I had similar thoughts that were already expressed. It would be good for people that you unpack a little bit why you have this impact. You go from a model from assets to income, you don't explain the relationship between asset and income, and then straight you show actually that inequality affects it. And one doesn't understand why. My understanding is there are clear assumptions there that need to be explicit. If we would have a model of decreasing return to capital with perfect financial markets, actually the poor would recover faster, which is clearly not the case. I'm not saying so, but that means you have clear assumption of what is happening: credit constraint, market failure, and it would be good each time that you actually show a result to give the intuition behind why do we see that. Similarly, I have two thoughts there. The first is, it would be also good that if you explicit a little bit the link between assets and income, because my impression is the poor relies much more on their own assets to generate income. Think about self-employment and informal micro enterprises. So actually, you could even worsen the impacts of damage on the poor, because the rich is merely a loss, but they produce somewhere else, while the poor actually produce with the assets. Finally, I was just, and then I don't know if it's possible, but I mean, it is great, but this is just a model, no? It would be nice to see if you have perhaps a couple of situations where you have household survey pre and post, and just validate the model or calibrate the model. If you could do that, it would actually give a sense to the extent to which the model is really good at capturing some of these aspects, and you can maybe change some of the parameters. So this is for the like more the technical part. And let's go back a little bit to the political part, and I don't think we should discuss it here, but just perhaps it's a discussion we'd be glad to bring it over. I find it great because you speak about socioeconomic resilience. I mean, I was just looking now, speaking at the GFDRR huge conference on disaster risk management in Japan happening in 3 weeks. There is extremely little about that. Like there is a lot about infrastructure, financing, preparedness, but about the socioeconomic impact, how to deal with the poor, very little. And actually, we at the global level, we are going to have someone going, but we chose not to participate much because it's not what it's going to be discussed. So if the model and the publication could be used to bring more of a social aspect, reaching the poor, how to ensure that the poor are really protected before, during, and after. I think it would be fantastic because we could merge all the adaptive social protection, ag, whatever literature, resilient livelihood with the disaster risk management. Maybe you disagree. Please let me know. I'm just entering to the field, but that's the impression I have. We have two very disconnected discussions, and if we can bring them together on some aspects, it would be fantastic, and perhaps this is a good avenue. So I stop here, and thank you very much.
Sorry, I think you are muted in the room.
Over to you.
Okay, yes, that's why I asked. I wasn't sure if it was my turn to come in, but no, thank you, Branca, Robin, Stefan, and Ruth for inviting me. I have a few slides. I promise that I'll be short. I do this to actually try to stick to the time allocated. Hopefully it won't be the other way around, but thank you, Branca, for uploading the presentation. So some of my comments overlap with what has been said already. Clearly, the model has made a lot of contributions since it was developed, moving from the traditional emphasis on physical losses to human losses, and doing it at a global scale, which is not an easy thing to do. Then also looking at the heterogeneity in socioeconomic resilience, not only across countries, as we saw in the presentation, but also within countries. And then also the fact that it looks at recovery paths, I think is a very interesting contribution. So, and good that is being updated over time, both bringing new data, stronger emphasis on distributional aspects. And so my comments are basically just some ideas about perhaps the next steps for extensions of the model. So next slide, please. So here in this slide, many of my comments are similar to what Jamele said, and is by focusing on physical losses, I think we're missing also other important channels, because the poor also rely on, well, much less human capital, but they still do have their human capital, their labor, but also natural and social capital. So disasters have affect these different forms of capital, which in turn can have effects on their incomes. The other thing is that capital productivity varies across asset types and locations. So not all the poor earn the same return on the same asset, even in the same location. Many of these things are shaped by a lot of internal and external factors. The fact that there are no linearities, in the relationship in terms of the impact of assets on income and well-being, and also non-linearities in the effects of shocks on assets. So it would be good to see how the model incorporates that. damage functions are we know from evidence influenced by a lot of different internal factors and external conditions. Another point is risk sharing. We know from the literature that risk sharing mechanisms and exposed coping strategies are imperfect, particularly for low-income households. But yet they still provide some partial insurance against events. So this is another point that I didn't see in the model. And then obviously other channels. Consideration should be probably given to channels through which disasters influence welfare and recovery trajectories, and that includes price effects, macroeconomic conditions, institutional factors, and also even in some cases levels of fragility. Next slide, please. So in terms of the welfare recovery analysis, I was a bit puzzled because you call it optimal, but we know that most contexts that we analyze are basically characterized by having a lot of different market and institutional failures. So it's difficult to talk about optimal welfare recovery. Actually, not difficult, it's inconsistent to work about optimality in this context. So perhaps second or even third best might be a better way to collect. And the other thing is the issue of perfect substitutability between the capital that is destroyed and the capital that is rebuilt. I don't think there is a one-to-one relationship. Sometimes the capital that is rebuilt is of better quality and better productivity, or the other way around. And then the issue of some losses being irreversible. When the clearest example is when people suffer serious health setbacks that lead to negative impacts on human capital, and this is what we know on the literature of the effects of shocks when you are affected early in life, and how this persists later in life by adulthood. So that is also something that I feel is very difficult to capture in this model. Next slide, please. In terms of future analytical agenda, I was thinking that I think the model is calibrated using some assumptions which are not always clearly linked to either theory or empirical evidence. At least I didn't see that. So it would be useful to present this up front. What is the rationale, either theoretically or empirically, to rely on some of the assumptions of the model. And then I wanted to, I mean, you know this, most people in the room, I think I was wondering if this approach could be complemented, or we should put more emphasis on the production of these standardized vulnerability curves for household welfare, which Ruth has been co-leading that effort. They did some work on the welfare costs of droughts in sub-Saharan Africa for a subset of countries in sub-Saharan Africa, where they actually estimate the direct impacts, the net effects of shocks on consumption. And empirically is a cleaner exercise, and they don't have to rely on a lot of theoretical assumptions. With a clear advantage is that it provides a thorough quantification of the welfare expenses that are incurred, and then include metrics like the increased number of individuals that fall into poverty, the expenses associated with addressing welfare losses, and more importantly, the identification of those that are most severely affected. Next, and this is the last slide. Just 30 more seconds. So a few final points for reflection. I found very interesting the result, the correlation between inequality and resilience in the cross-country data. I think this deserves more discussion. And I think the example provided there, Namibia, which has a GDP per capita that is much higher than Bolivia, is almost 60% higher than Bolivia. It has much lower poverty, but is among the most unequal countries in the world. And that country appears to be much less resilient than Bolivia. And so I wonder what is the explanation for this. The second is in your calculations, you show differences in the levels of resilience across income, different income countries, countries belonging to different income groups, but those differences are not statistically different across these income groups, except for high income nations. The third one is on the you benchmark early warning systems, and you call them perfect early warning systems. But I don't think I wonder if that's a good benchmark, because even in a perfect system where you transmit information to everyone on time and it's information that is easily understood by everyone, many assets are immobile or timely or costly to protect. So I don't think it's realistic to assume zero losses in these cases. In terms of comparing households with and without liquid assets, I was wondering why they have the same level of capital at time t equals 0. I mean, at the time of the shock. I think there are many differences between households that have and don't have liquid assets, and that is translated onto also in the capital portfolio that they have, which is probably comprised of assets that are more resilient, also ex ante. And finally, in the policy discussion, I think the role of access to and the functioning of markets, there is emerging evidence showing that is a key way to reduce the effects of shocks on household well-being. And also physical mobility and good service delivery, quality of service delivery are important factors too. So I just wanted to stress that to perhaps be in even more space in the discussion. Thank you very much.
Super. Thank you very much, Javier. There's a lot of great content there. So, I mean, over to, I don't want to put it all on you, Robin, to answer, but if you wanted to pick a few of these to start with, and then maybe Branka and Stefan, and I see that I'm also down to respond as well. So I can also chip in on maybe some of the comments as well.
Yeah, sure. No, also thanks a lot for the comments from my side. Maybe because I just have them present right now, some of the last comments by Javier from the last slide, I think that's actually something that we only discussed recently with regards to the results. What you said with regards to Namibia being less resilient than, for example, Bolivia, and this is actually a thing. This is in this case very much due to the inequality that we have in the country, right? And I think the essential thing maybe to mark is that, of course, resilience is one important indicator to look into, but maybe some countries, I mean, some countries when they develop, for example, then you will necessarily have some degree of inequality, right? So it's not necessarily always a negative thing when then due to that resilience decreases, right? So it's just one dimension to look at. And in the case of Namibia, this is exactly that we have high inequality, and therefore the lower income quintiles, when they experience asset losses, well, then their resulting well-being loss per dollar asset loss will just be bigger. And I think the other point maybe that was also just a miscommunication from my side, or maybe I misunderstood the point, but what we mean by perfect early warning is not that vulnerability is decreased to 0, right? But the assumption that is based on case studies is simply that early warning systems can reduce vulnerability by up to 20%, right? And this is also, I mean, there's obviously a lot of factors that go into early warning, but like how well is it disseminated, how well are the observations that we require for early warning. So there are many factors that go into early warning already, but in the model it can at most decrease vulnerability by 20%, so it can never result in 0 losses. And this perfect scenario was simply where the vulnerability was reduced by exactly 20% for all countries. So maybe that was a somewhat miscommunication there. And then I don't know if I fully understood the last point on the same level of capital loss. If I understand you correctly, then your point is those households with liquidity should have more capital as well, right? Because we would expect liquidity and productive capital to correlate somehow. And maybe here again, this was more of a thought experiment, right? So we derive liquid savings and the ability to borrow from the Findex data set. So there is basically this question that people are being asked, would you be able, and how would you be able to come up with 1/20th of the gross national income of your country? And based on that, we estimate how much funds people have available or could come up with. And then just as a kind of thought experiment, we took that away and looked into how much would resilience decrease. But of course, in an actual scenario, those two I would expect to correlate. And then maybe just on a general note, I think that's actually an interesting thing also that Julie and Jamila raised with regards to calibration and sensitivity. And I think that's actually something that I definitely still had on my to-do list to look into why some countries have high and low resilience. For example, I mean, we looked a little bit into Haiti and into Tajikistan, and there, for example, it is, for one, the inequality that is very different. And here again, one might ask whether or not then the resulting lower resilience of Haiti is a problem. And I guess one would have to look into how and in what direction incomes and inequality develop, right? Another role here, I believe, if I'm not mistaken right now, is, for example, the degree of self-employment or the rate of self-employment. That is also something that I believe Jamila raised. So we do account for the self-employment rate because we estimate shares of capital that are being owned by private households versus, for example, infrastructure or also firms. And for that, we use self-employment because we assume that, income from self-employment is generated using privately owned capital. So we do, to some extent, account for that and can also then look into, and I think that's a nice thing that one can then do, look into how resilience depends, for example, on the self-employment rate and factors like that. But I do very much agree that this is something that could be added more to look into the drivers in terms of the sensitivity analysis of the individual drivers. And maybe I really like the idea of kind of comparing pre and post disaster. I believe that might actually be somewhat difficult from a data perspective, but I'd be really curious from what I know how the data sets look like. I mean, they're published, I don't know, on an annual, maybe biannual basis, right? So I think you would have to be kind of, it's a weird word to say, but lucky that the household service would be conducted right before and right after. I think it's probably more of a data problem than a technical problem, but I think it would be really super interesting to do something like that. Maybe I'll stop with that for now. If you want to add any points.
Thanks, Robin. So from me, I think there are these 2 points. One is indeed about the empirical validation, which is quite a challenge, but then we see some openings. For instance, we started collaborating with the SPJ team in Dominican Republic. They had some evaluation of post-disaster support, and they carried out surveys on the benefits of this post-disaster support. So there are some openings with some country-specific teams, definitely not at the global level, but there are things that we are starting to pursue as well. And second is about bringing this to more the disaster risk management community. Jamila mentioned about the understanding risk. So at least for me, who is also based in GFDRR, something we try to push again. We fail in this UR, but there are actually some sprinkles of socioeconomic topics or equity topics in different sessions in the understanding risk conference. But we agree that this is something to bring forward again, basically.
Yeah, maybe I can just add a little bit on the calibration validation, because indeed it's kind of tricky to do. I mean, you mentioned that the study on consumption are cleaner exercise, but when you do it, it's not very clean either, right? Because of the data challenges. I think we've had some ex post validation. For instance, when we were working on Fiji with Brian and Julie, we had Cyclone Winston that affected the island a few years before, and so we could do sort of a validation of the orders of magnitude. but clearly we did not have the clean household surveys needed to do that. And that's one of the reasons why, and Alvina is here, I haven't seen you in a while, who was doing this work with GFDR of doing specific post-disaster surveys to try to understand who was affected and how, using some methodologies that you don't have to redo the full consumption survey, which is very difficult to do in those circumstances, but basically using, what was the name of this?
Swift.
The Swift methodology to try to assess the impact on consumption without doing the full 2-hour household survey. Again, we had some estimates, but it was more like comparing the orders of magnitude and not something that would allow a very clean calibration. Especially what was really, really hard was the sampling, so that you have enough of the population being actually affected, especially for floods, which are very, very heterogeneous. It's not very easy to have the right sample that gives you all of the strength that you want. So, I mean, to me, and because this work is always struggling with the hazard map, which is always very uncertain. To me, really, the way forward is not one or the other, right? It's really like combining the two approaches, using the natural experiment that we have with disasters to check the validation and the results, and then we can use the model to also extrapolate to things that haven't happened in the past, which was one of the discussion in Turkey, for instance, when you have this big one in Istanbul that might happen at one point, and you clearly don't have in your historical data sets something to look into this. So the idea is, if you can gain confidence that your model reproduced well what you have in the historical series, then you can do a real risk assessment, which is covering all of the possible events and not just the ones you had in the historical database. But clearly, this is something where I think bringing together, especially the impact assessment that SPJ has been doing more and more of, which is maybe a good way of approaching the problem, into this type of modeling would be the way forward, and maybe a good excuse to have Hamele coming to Japan next time. So maybe Alvina, you want to just come in on this too.
Yeah, I mean, so I think correction on, I mean, we use Swift. Well, Swift helped us understand the kind of levels of consumption or proxy levels of consumption in the population, but we weren't able to, understand the impact of the disaster on consumption, right? So that I think based on poverty levels, we were able to see these households were affected in this way, or like poverty is a driver in the pace of recovery, for example, perhaps in one place, but in another, access to informal sources of finance or access to formal employment mattered more for recovery. So it's kind of, I think the Unbreakable framework helped us ask questions and structure our analysis, but we weren't able to replicate or understand pre and post in a full way to kind of calibrate the model. But it was helpful as a framework to structure our analysis and interrogate some of the I think findings of the Unbreakable model. But not only I think was it a challenge in terms of sampling, not only is it a challenge to sample, enough households have been affected by hazards, especially in a context where perhaps there hasn't been a big event, where you're just looking at the risk of flooding in general. Another challenge for household services is also getting the income distribution represented in the sample to understand, rich versus poor. Most of our households were, on the lower end of the spectrum, and that's often what the client, what the counterpart, what the partners are interested in understanding and targeting, and they're not interested in having us send us out to the richer neighborhoods to ask questions. So perhaps we have some middle class in there, but that's about it. So that also limits our ability to say things about the whole population, I think. Yeah.
And one thing I wanted to mention is when we use household surveys, like the normal, quote unquote, the ones done for the usual poverty measurements, one of the challenges is how much do we capture some of the impacts of the type of disasters we're looking into. So for instance, the impact on housing is not always well captured by those surveys. In some cases, it's even excluded. I think that's what's your problem in one of your country where you don't have the housing services counted in the consumption aggregate. And so if you remove the housing services because you have lost your house, it doesn't change your consumption aggregate and poverty levels, which of course is an issue. I think we have the same issue with, Javier, you mentioned the access to infrastructure services. We have a little bit of the same challenge here. Like if you're losing mobility because the house is broken, because it's not something that you pay for, it's not captured in the consumption aggregate. And so you're losing a lot of those impacts. And so there is a lot of questions about what do we capture, what do we don't capture, and things that are completely okay if you want to do the long-term tracking of poverty, for instance, might not be okay if you're interested in what's going on during a 12-month window after a big disaster where things will be very different. So we have our colleagues from LSMS connected, but we have this conversation about how can we change the LSMS questionnaire to better capture what's going on just after a disaster.
Yeah, and I wanted to just come in as well with a couple of.
Yeah, just on that, a quick thought. I mean, I don't think we need, as I agree with you. I mean, the survey analysis would just be to understand whether the model is more or less right in some of the big trends and the order of magnitudes. And there, I think, you have the Chilean, for instance, household survey done every year with all the modules you want. I think they have a panel, or many of these LAC survey actually have at least a component of a panel. And a year is it's at least, I mean, and then you have the earthquake in Valladolid, and you have other disaster. It would be, you have El Nino. So I was wondering, just, if you identify 2 or 3 cases with a year window, and at least understand whether within this 12-month framework, which is still fairly short, your model is calibrated right. That would be already a very strong result. So I don't think you need to rely on LSMS only. There are other surveys that actually are pretty good.
So maybe I'll just add some comments here. I think so. If you sort of take the survey approach, and this is what Javier was suggesting on sort of like the vulnerability function, the damage function approach, and this sort of comes back to sort of a comment that I made at the beginning, which is that you need to be taking multiple approaches to try and answer this question, because yes, you get a very clear idea of something from doing that analysis, but it's very incomplete. It's very partial. Your identification is coming purely from variation across space and time on things that you can observe after a household has done a bunch of coping. And the advantage of doing the sort of more assumption-driven modeled approach is you start to see, well, does that, what are all the things going on behind the scenes there that, might be adding up. The disadvantage of the model approach is that you are making all these assumptions. And so I think sort of from the comments that in the room that it was great to get, it was sort of like, it's really be great for us to work out how to tell a story around those assumptions, right? What assumptions are leading, as you were saying, sort of unpacking a little bit that link between the asset loss and the welfare. Like, what are all the bits, and what are the assumptions made, and how do things vary when the assumptions change? And Robin, you already presented a bit of that, but maybe there's a bit more work to do there that would help people understand the results, help us understand the results and what's driving them. And then also, I think that work could also identify areas where we need more empirical work that we haven't traditionally been looking at. So, for example, in our surveys, we don't collect data on some questions that would help us better understand the speed of recovery and how that varies across different households. So we could think about, well, how do we start to add those sorts of questions into our surveys? So that we're not just sort of focusing on the end income or the end consumption or the end asset, but like what actually was the process. We could think about sort of other things where we'd like more evidence as well, like does a perfect early warning system really reduce vulnerability by 20%, or what kind of additional data points do we need there? So I think that bringing together these different approaches is really, really helpful because it helps us see, where are our big knowledge gaps and actually do they matter? Like if we sort of do this modeling work, does it look like this is an assumption which we need to test a bit more? So I think for me, these comments have been really, really helpful. It's a huge amount of work that has been done just to get all the data updated and to this point. But I think it's sort of now that we have that we can start to sort of think about, well, how do we tell this narrative and hopefully use this work, not just to come up with it's this many $1 billion of losses, but to come up with like a better understanding of, well, what are the things that households need? What are the things that really matter for improving resilience in different contexts? So for me, these comments already have been really, really helpful. And I know that as chair, I probably shouldn't be jumping in and responding, but I couldn't hold back there.
I think that's fine. Just
Yeah.
one thing on the time for reconstruction, because so I think it comes from Julie's point that explaining welfare losses is a nightmare. It's always been so difficult. I think with Brian, we tried all of the possible sentences to explain that, and it did not work very well. And the time for recovery was a much easier way of communicating.
Yeah.
And now that we're talking about it, I'm thinking, Javier, maybe on the validation, this is a much easier validation point. Like when are people back with their reconstruction process? You can add that as a question in a survey.
That question, but it'd be very easy probably for people.
We did.
Oh, you did?
Yeah, we did.
Oh, great.
So we've also asked it of the model and at the country level, and actually that's where the former global model sort of started to fall apart because infinities emerge when people are near the poverty line in the welfare function. And it's true, like over time, trying to do this at country level, explain welfare losses, why they should care. At the end, I was confident that they shouldn't. And the things that it can predict, like the recovery time by income cohort, for example, like I think we saw that overall. It'd be really interesting, even to begin to get a sense of like, does this global model comport with expectations, would be at the income quintile level, what is the expected recovery time? Another one was the integrated consumption loss over like 10 years after the disaster, for example. And of course, this model has that by income quintile as well. That's a positive prediction that's actually verifiable in over time. A third one then was sort of at the individual level, thinking about the individual probability of recovering from a shock within 5 years, within 10 years, because that's the advice that's then relevant for, I think, like an intervention conversation. So those things, that it was actually starting to ask those questions that led to the growth of the country level model and all the data that are available within the individual household surveys. And I think that, at this point, those numbers are in here as well. And to look at that would just start to tell us, does this probably hold water?
Any other comments online or in the room or questions?
A couple of comments on the on the main ideas here. I'm from SPJ as well with Jamel. Bringing the social part into the story is essential. I think that not only from a practical perspective, because the governments want that, but also because the discussion in other spaces like climate finance and carbon markets is increasingly adding a social element into the discussion. Why? Because you need an intervention that is not only doing reforestation and sequestration carbon, but if you adapt the social element into those interventions, the price of carbon credits is even higher. So there's a story there to be pushed at a different level. The other point about the validation process is that the Unbreakable data has been super useful in that kind of cross-country dialogue. I was last week in South Africa with a bunch of countries in the Southeast Africa, and the message was very clear. Roughly half of the population in those countries is exposed to shocks. And even worse, 78% of those exposed are poor. So with that message, we're already building a conversation where this is going to be important. Now, the question is then, how do we move into a country level discussion and how we use this data to both help us in the dialogue, and we use the the local data in recalibrating or refining those models. In Mozambique in particular, we've been building some, it was previous work, geospatial urban poverty maps or vulnerability maps with a bunch of caveats. And the idea was to have this overlap of the flooding maps, the census, and these vulnerability maps. This is with help of GFDRR as well. So I mean, how those exercises can help refining this kind of models. And a final comment is the work that is being done in some African countries is showing that with climate change, there's a trend about exposure, but the key factor for exposure is actually urbanization. Is this movement of people into peri-urban areas that are in high risk, subject to flooding, for instance, that are going to be affecting us. And I don't see that kind of message coming. I mean, reducing exposure is the most important factor in the overall message. Okay, urbanization is going to be at the center of that conversation. Yes.
Great. Maybe one last question.
Ruth? Sorry,
Yeah,
sorry,
no,
Ruth. This is Javier. Very quickly.
Oh, we're muted.
Please go ahead. Go ahead in the room, and I'll come.
Javier, you go.
Okay. Sorry. No. Very quickly. No, Robin was reacting to one of my comments on inequality. Yeah, we can think about ways in which inequality can definitely reduce resilience. But the thing is that in your cross-country sample, the ones that you highlight actually are a very good example, because Namibia is a fairly small country, very large, and it has just over 2 million people. Its GDP is almost twice as high as in Bolivia, and it has much less poor people. And so this inequality is actually explained by a lot of wealth on the top of the income distribution. Yes, there is also poverty, but much less than in Bolivia. So it's an unequal society, but on average, the standards of living are higher. And so that's why I find puzzling that inequality explains. And I wonder if inequality in this case is proxying for something else in the data. But it's just a thought, and it's obviously something that requires looking into this more carefully and doing it at a country level, perhaps. Yeah, it was just that. Thank you.
Stefan, and then...
Yeah, no, I think that's a very good point, and in devils being into the details, one of the big choice in the model is the welfare function that you use, and whether the welfare function is basically country per country, or if you basically have only one, right? And so we went back and forth on the choice, because if you have a unique welfare function, basically, the ranking of countries is driven by only their GDP per capita, because the elasticity of consumption is so big that it drives all of the results. So here, what we were doing is we take every country with its own welfare function, and we don't have the difference in elasticity playing across countries, just within countries. And I think that explains what you see, Javier, and you have good eyes to pick it up. And when we had this discussion, and I think it comes back to Julie's question, that the question was, okay, what will we use that model for? And I think that's a little bit where there are limits to the ranking that we do with the model. And one thing that was more useful is comparing the ranking of policy options across countries. And so I think it makes everything a bit easier to communicate. Like you have with countries with super high inequalities, for instance, you had very different recommendations coming at the top than in countries with lower inequalities. But it was not meant to look at transfers across countries like the global aid and these type of things. So I don't know if it clarifies, but I think you're making a good point that there are limits to the the comparisons that we're doing across countries, because there are a lot of political choice in the welfare function that you're using, and that is, as my statement makes perfectly clear, is also very difficult to explain if you're talking with a decision maker, right? To explain why that country is number 3 and that country is number 10. So a focus on policy priorities is probably an easier use of the model.
I mean, it kind of comes back to the last question I had, which was on the role of the country model that also exists and that I found very useful because you have the spatial disaggregation and you can talk about urbanization and changes in exposure over time. And so I was wondering, you know, what's happening to the model. If there's a plan to keep using it, or if it's more the global model, and if it's the global model, are we really trying to rank countries, or because, you know, coming back to CCDRs, each CCDR has a paragraph that says that this country is one of the most vulnerable in the world.
Yeah, every single country.
Every single country, yeah. And I'm not sure you want to, I mean, I don't know, ranking countries on vulnerability is just so hard. There's just so many dimensions of it. Having one number to rank countries is probably not the one thing you want to do, but it's still nice to be able to compare countries together, but probably not on one dimension. I mean, it goes back to the unpacking of that you were talking about.
And I think so the country model started when we published the global study, and the Philippine government picked up on it because it was in the news in the Philippines, because they are by geography interested in anything disaster related, right? And they were saying, oh, that's interesting, we're really high on this ranking and so on. Can you just help us look at what it means within the Philippines? And so we started doing the country level with the full range of data, because the Philippines is relatively data rich. And because we had all this data, that's where the branch happened, right? The model in the Philippines got much more sophisticated. And we kind of, at one point, the idea was to just get rid of the global one, because we were seeing like an engagement at the country level, basically doing the job. But I think to open conversation, it's kind of nice to have something at the global level that you can mobilize in 10 minutes, because you have the data set already there. We see that with Lifelines and the other tools. So to me, the idea is to use that as an appetizer, and to use it to, I think, make the case, and that's a bit your point, make the case on the role of social aspects into disaster resilience, for instance. It's much easier to do it with a global tool than it is with a set of case studies. So we can also use for that purpose. But ideally, we would converge, right, and have the global tool being just the aggregation of country per country. And in the work that Robin has done, the number of households now can be changed, right? So I think it's also planning a little bit that this can become more refined, so that the national and the global model converge.
Great.
We haven't responded on health, but to me, that's something that I would love for us to just work more on, like how the health and education impact for children create like a 20, 30-year impact on growth. This is not included at all in there, but over the long run, it might be the biggest channel of impact, right? So that would be a really important thing that I would love to be able to bring in. So that's a good point.
One direct way, rather than way for the GDP growth, is having the impact on human capital index. I mean, that is super simple. Because you have malnutrition.
Great. Well, if there's no further comments online, no. And thank you all very much. And if anybody's online and in the building, then there is food out here, so do come and get a sandwich.
There's a lot of
and
food.
send your friends and neighbors over as well.
Thank you.
everybody.
Yeah.
Just
Bye-bye.
that Robin is leading us now.
Sunday.
Yeah, it's the last days of his contract. It was great to have you working on this.
Yeah,
And,
you've done an amazing
thanks
job.
very much.
Thanks a lot, all of you too. Yeah, it's been very fun.